Thank you so much, Joe, for that kind introduction. My speech name today is Opportunity Cost, and I'll get back to that a little bit later. But let me just say I'm honored to be at this year's conference. I was lucky enough to be at the first conference, I guess 10 years ago, this being the 11th conference, because Joe invited me to it. And I remember at the time writing a note to Joe after I got back saying, what a great niche this conference filled in the then banking environment, and obviously still does, and that I hope that it would continue on, and it has. So I'm glad it did, and so here I am. I would also like to thank Joe Face for all he has done for banking, especially in the Commonwealth of Virginia. He's been a strong protector of all our banking laws, and we have a fertile economic environment in Virginia. Virginia is always in the top 5 best states to do business from CNBC, Forbes, and all those polls. And a large measure of that is the stewardship that Joe has provided over our banking code and banking laws, trying to encourage economic growth in Virginia, and he's done a great job. Anecdotally, I will say, in the American Banker listing, the top 200 community banks based on return on equity, this past poll, a quarter of all the Virginia banks made that listing. So that's a testament to you, Joe, and all you've done to foster economic environment in a safe and sound way, I would say. I'd like to thank the St. Louis Fed, too, and Jim Fuchs and his staff that have been great to provide support to this conference. It has been very easy for me to plug into. And I know you got a lot of thanks yesterday, but they're all well-deserved, all the support staff, too. And also thank you to the partnership of the CSBS, the Federal Reserve, and the FDIC for recognizing how important the collaboration that happens at this conference is and how important it is to community banking. Thank you for that. It's a real exclamation point to me as a community banker looking from the outside as to the importance of our dual banking system and how important that is, why our financial landscape is the envy of the world. You know, Western Europe doesn't have community banking, Canada doesn't, but we do. And we're the strongest economy in the world for a reason, and a lot of it's in this room. Also, thanks to the Federal Reserve and all the researchers that are here who make a living from studying our industry and helping us to make it better. You take anecdotal stories from us and you give them power and credibility. You provide us with data to help fodder for things that can make legislative and regulatory change, and I truly appreciate that. I would like to say that my opinion is that all legislation and regulation emanates from sound empirical bases, but I'm not sure that's always the case, but you all definitely help in that regard. And last but not least, I know she had to leave, but I'm very appreciative of Governor Bowman, of all she's done at the Board of Governors level, representing community banks, and specifically her taking up the cause of de novo formation and how important that is. I'm thankful for her efforts. I'll go through this quickly. My bank, Chesapeake Bank, was founded in 1900 as a bank to serve the local businesses, which were largely watermen. You saw the video yesterday, crabbers, oystermen, fishermen, et cetera. Our headquarters is in Lancaster County, and Joe gave the historical lineage there. I think we were formed in 1651. Actually, George Washington's mother was born in my county, Mary Ball. And we have about 180 miles of shoreline. So through the years, while there's still a strong seafood business, it has morphed somewhat into a retirement community too, a lot of waterfront living, which is a good balance. We're currently about a $1.3 billion bank, and we also have a wealth management entity. For us, we were a little bit provident, I think, in the mid-90s, and we formed two. We call them Specialty Alternative Revenue Centers, SPARCs. There's a joke in the bank. I used to call them Specialty Lines of Business, SLOBs, but they made me change that. They would not let me continue to use that. One of them is an entity called Flexent that provides receivable financing, and it's national in scope. And the other one is Chesapeake Payment Systems that provides merchant card processing to businesses and is also national in scope. Those two are very important for us. They provide about 25% of our net income. And to a large extent, they are counter-cyclical to the bank. So they definitely support our margin at the core banking level and have allowed us to be in the top 200 community banks, American Banker, based on a 3-year rolling ROE for the last 15 years. And so they're a large component of that. My perspective, I've been in banking since 1990, after having been a CPA for 7 years. I started in banking not fully recognizing what starting in banking during a recession actually meant. I think you can label that young and dumb at the time. I didn't really understand what I was walking into. Chesapeake Bank, we had considerable regulatory issues in my early years, and I went in and headed up loan administration. And I will say those years were truly a teacher in disguise for me. I didn't recognize it at the time, but I do now, and it's very helpful. And I'll also say it gave me a great appreciation for the importance of the dual banking system. When after several years, we switched charters to become a state member bank after what I felt was somewhat overzealous regulation. And I think we felt a slight point of pride there in that we were in a net recovery position for 6 consecutive years after our switch. It got to the point where our board of directors expected us to be in a net recovery position on our loan portfolio, and I had to say that is not the model that banking is built upon. We actually are supposed to incur some losses as we take risks in lending, but we eventually got to the point where we are now. I do think about that time very earnestly, actually, as to what our community would look like now had Chesapeake Bank not survived that. Had we just folded and gone home or sold or whatever, it would not be the community is now. So I'm possibly a little overzealous myself as a proponent of the importance of community banking in our country. I know I'm going back here, but have any of you ever seen the 1971 movie Brian's Song? Anyone seen that? It is a great movie. If you've not seen that, you've got to see that movie. It tells the story of 2 football players, Brian Piccolo and Gale Sayers, and their unlikely friendship in the late 1960s Chicago Bears. I know it's a spoiler alert, but Brian Piccolo gets cancer and dies. And in the eulogy, Gale Sayers, the seminal line in the movie says, "I love Brian Piccolo, and I want you to love him too." And I can honestly say that I love community banking, and I want you to love it too. The parallels of the two, the football player and the industry dying, are not lost on me. And one is happening just much more slowly than the other. So what is it about banking? As Joe mentioned, my father-in-law died about a month ago. And the condolences I've received from both my wife and myself, without exception, all mentioned what he did for the community and our industry too. Banking is an altruistic brotherhood like no other. We all want to see community banking succeed. And I would ask, what other industries that you are aware of are out promoting the formation of new competition? You know, I think this is a testament and a sign of the overarching importance that bankers see to their role in the communities. We want competitors. We want de novo formation. My fear is collectively that we are the people on the city street with the board, sandwich board sign, the end is nigh, and everyone is just walking right past us, ignoring the message when it is so vital to their lives. Let me outline this importance. As far as the problem, in reviewing some of the prior community bankers that have spoken at this conference, the problem is self-evident. There were 15,500 FDIC-insured institutions when I got into banking in 1990, and there are roughly about 4,700 currently. I'd already formulated what I wanted to say in this year's speech when Jim so graciously asked me. And I watched last year's keynote from Clayton Legier, correlating community banking to an endangered species and what lengths we should go to protect this endangered species. And after I saw it, oh well, there went all my talking points. But seriously, it is an excellent speech if you go back and watch it, which lucidly and cogently outlines the problems and what can be done. I would like to go even further today, at the risk of putting out stupid, half-baked, or plain ill-conceived ideas. Why? Because it matters, and ideas do matter. Most, if not all of you know that the top 158 institutions, those greater than 10 billion, account for about 85% of the total banking assets in the country. So assuming there are 4,700 banks, that leaves roughly 4,500-ish that account for the remaining 15% of the banking assets. This cohort is often referred to as community banks, and you heard Governor Bowman talk about 10 billion being the Dodd-Frank cutoff. It may be a different day's discussion, but I would question the ability of a bank north of 5 billion to function as a community bank as I know it. And there are obviously many exceptions to this opinion in the room, and I know that. But with only 15% of the banking assets, community banks account for 36% of all small business lending in this country. So we are outkicking our coverage by more than 2 times. In the United States, these same small businesses represent half of all non-public jobs, half. And they also account for 2/3 of all new job creation in the United States. So let the implications of community bank slow extinction sink in the light of those statistics. Community banks, I would argue, are one of the most important economic levers driving the strongest economy in the world. Absent excessive or ill-tailored legislation and regulation, we can discuss that later, this lever has the ability to unleash the creative ability and the power of our free market economy. But if it withers and dies, it cannot. This is especially germane to rural areas like where I live. We have seen urbanization take our best and brightest from rural areas for decades. It is incumbent upon community banks to enter the breach in our communities and help provide opportunities for those to stay and even those to come or come back. The stakes. I was talking with a former pastor of mine about sermons years ago. I know that's dangerous territory. Sermons can talk about what Paul did or what's the historical backdrop in which certain stories played out or what the different interpretation of the Greek or Aramaic meaning of certain words are, et cetera, et cetera. It can go on and on. At the end of the day, the listener is just asking, so what? How does this relate to me? And I think we need to make that point as far as community bank retention and de novo formation. De novo creation is always viewed in terms of risk. How much capital? What is the burn rate? The cost of IT and cybersecurity is so much higher these days. The cost of compliance alone prohibits a new bank from starting up. The reasons go on and on. While not being dismissive of these reasons, they are all true to varying degrees. The conversation should not stop there. We're all in the risk business, not the elimination of risk, but the mitigation of risk. The losses from all bank failures over the last 40 years cumulatively is $1.4 trillion. That is just 5.6% of 1 year's GDP of the United States. So 40 years of losses is only 5% of 1 year's production. The stakes are high, so what is so different? A good friend of mine started a bank in 1999 with $6.3 million capital raise. And he grew that bank to $2.5 billion over 25 years, serving the needs of West Texas. A comparable capital raise right now would probably be in the range of $30 million or north, and that's just too high. Well, a bank failure can be costly. I agree, but as compared to what? What's the opportunity cost of that bank failing, not forming? So how do you evaluate the opportunity cost of, one, community banks that never started due to high barriers of entry? Two, community banks' slow extinction in what could have been if they weren't lost. My bank is a prime example of that. What small businesses did not get credit to grow 36% of all small business lending that comes from community banks? Four, how was 2/3 of the job creation of our whole country coming from small business affected since these credit needs were not met? And five, what civic organizations did not have the financial or intellectual capital to make positive change in their communities simply because there was not a community bank there to spearhead that effort? Each community bank in this country were learning centers for our employees that train them to be community leaders. They don't come into our banks as community leaders. They become community leaders because of what they learn working at our institutions, and is vitally important for those locales. To put a finer point on what we're discussing here, there's a line from an Indigo song years ago that says, "We sailed our ship of safety till we sank it." Are we doing just that? So the elusive solution or solutions, it's always easy to point out a problem, but formulating and moving potential solutions forward is the 3 yards in a cloud of dust, to quote legendary Ohio State football coach Woody Hayes. Everything I say from this point, this is humor, just in case. Everything I say from this point forward is the opinion of Jeff Szyperski and not the Federal Reserve of St. Louis. I just had to get that in just for I couldn't resist. They are just raw ideas, but they're worthy of empirical questioning. So here we go on some ideas to invigorate community banking, retention, and formation. As it relates to retention, eliminate credit union acquisition of banks except in the most extreme circumstances. In other words, as a last resort. This is an easy one from my position. There are now more credit unions than banks in the United States, and does this lost taxation and no CRA requirements not alarm anybody? It's a big deal. Two, I question the efficacy of hedge fund ownership and heavy investment banker influence in our industry. I'm a free market guy, but I do feel like there's a lack of proportionality in the market right now. I truly feel that once you step onto that hyper-capitalist train, there is no getting off, and it only leads to one station. The frenzy created by short-term expectations for shareholder returns can lead to short-term gains and long-term pains for the communities that we serve. Three, initiate a comprehensive study to see short and intermediate effects on a local economy of a community bank being displaced. This would also apply not only to headquarters being lost, but also to a strong community bank branch. I think we know what this looks like, but we have no raw data to see what the slow poison that this brings to our country, and especially small-town America. You are the ones to do this. Four, can a minority position in bank ownership be changed to allow small municipalities or counties short or intermediate ownership stakes to help formation or retention within their locale? I'm talking about a very limited non-controlling position. I know this is contrary to what our current system design dictates. Does a county or city just sit idly by and watch their community institution vanish, especially considering how important that is to their community? I realize there are state laws on both sides disallowing this, and for good reason. But to quote Shakespeare, moderation in all things. And just to be clear, I do not think a public banking model, as proposed by some, is even close to the realm of a good idea. De novo formation. I wonder if it'd work if banking commissioners got with each other and their respective secretaries of commerce and outlined best practices for new bank formation in their states and nationally. Apply some state-level metrics to what this extinction issue actually means to their states. Just like we have the best states for business, could you also have best states for banking formation designations? The risk of state shopping, I know, could happen, but this is a manageable risk. Right now, there are no pitches to even swing at. 2, could the FDIC suspend deposit insurance assessments for the first 5 years or until an institution hits a predetermined deposit level to reduce this barrier to entry? I would argue most of the losses are not coming from that cohort. Could the regulators adopt rules like proposed in H.R. 758, the Promoting Access to Capital in Underbanked Communities Act, as from Kentucky Representative Andy Barr, that provisions for a 3-year phase-in for new rural banks to comply with federal capital standards. 4, could public or private partnerships be formed with regulatory blessing to act as bank-like CUSOs, which are credit union service organizations, that would provide a plug-and-play to startups for core processing, compliance management, ERM, cyber risk protection, and other basic banking functions so that all the initial capital is not buried and raised that go into backroom personnel and technology that is just simply needed to get the doors open. Yes, I know this is riddled with things that could go wrong, but when looked at through the lens of a macro opportunity cost, does it make sense? Could there be a capital gains haircut on the subsequent sale of a bank formed if it makes it to the 10-year mark? And could this initial investment credit be phased in to be higher the longer the bank remains independent? And then also garner widespread report for H.R. 1533, which is Promoting New and Diverse Depositories Act, sponsored by Jake Auchincloss, a Democrat from Massachusetts, and co-sponsored by Patrick McHenry, a Republican from North Carolina, which advocates for an 18-month study to examine the challenges prospective de novo institutions face. You know, when you get a Democrat from Massachusetts and a Republican from North Carolina, that bill probably has merit. That is unlikely bedfellows. Though I understand it, my initial reaction is 18 months seems like a decade in the current banking environment. I'm sure there are many other ideas. No one idea would change the landscape, but a combination of many might just help. So the title of my speech is Opportunity Cost. It is with much trepidation that I decided to talk about a core economic principle to this group. With my business and accounting background, especially accounting, where everything balances and the universe stays in orbit as long as everything balances, I fondly remember my 2 econ courses in college as being difficult since they were so theoretical. I will say, though, my 40 years in business since has given me lesson after lesson of the real-world effects of opportunity cost. To quote the great economist Wayne Gretzky, you miss 100% of the shots you never take. I feel that this is where we are now. We are currently at an inflection point where the long-term positive influence that community banks have on our country is past waning and is almost to the point where it cannot be recovered, and I do not think this is hyperbole. Serious problems require not only serious study but also serious action. I implore some of you to take up this cause. We should know with some precision the opportunity costs of a community bank becoming a glorified branch of a larger bank. 2, we should know, worse yet, even in the digital age, the opportunity cost to a community of a community bank headquarters closing altogether. And on a more macro level, what are the effects of job creation, given the statistics I've previously quoted? It is just too important not to push forward and to not only examine the costs of this slow extinction, but also provide actionable data and proposals to fix this national crisis. I ask your help. Thank you.